Yeah, in the last class we have stopped with which area? We have stopped with which area? With question number 59 we have stopped. Let us go to the question number 60. Let us go to the question number 60. They ask you under perpetual inventory system, FIFO, periodical or perpetual, it will give the same answer. Okay, FIFO, periodical or perpetual will give the same answer. So if you look at the quantity, 1400, 1800, 1500, total quantity is like 4700 is the total quantity. Sales is 3400. The balance quantity is 1300. 1300 will be valued based on the latest price. Old stock goes out, the closing stock will be at what price? Latest price, that is what we had seen, and that is what happens. 3770 is the answer. Any doubt in it? Any doubt in it?
No, sir.
Question number 61. Question number 61. They ask you under first in, first out, last in, first out perpetual inventory system. They ask you cost of inventory. They ask you cost of inventory. So how to work out inventory? If you look at there is a sales. In the sales, 1800 would have been out of this. Balance 200 would have been out of this. What will be the stock? Out of 1400 balance, that's 200 goes out of this. 1200 into 2.45. Right? Next. The purchases are 1500, sales are 1400. The balance stock will be 100 into 2.9. Right? Sales 2000, last in, first out. So first the 1800 goes out, then balance 200 out of the previous one. So 1200 into 2.5. This 1400 out of that, okay. 1500 out of 1400 gone out. So balance 100 into 2.9. What is the correct answer? What is the correct answer?
3230.
3230 is the correct answer. 3230 is the correct answer. Good. Go to question number 62. We follow last in, first out inventory accounting system. During inflation, last in, first out. Cost of goods sold will be at the latest price. Inventory will be at the lowest value. Which one is correct?
Option B.
Higher cost of goods sold and lower inventory value. Higher cost of goods sold and what? Lower inventory value, because whatever is sent out will be at higher rate and the inventory will be in the oldest price. So that will be D. Question number 63 part. Question number 63. We are using FIFO method. Impact on inventory valuation should be periodic inventory system to perpetual inventory system. FIFO, periodical or perpetual, we have learned. Will it make any difference? FIFO, periodical or perpetual, the inventory value will be the same and cost of goods sold will be what? Same. Whether it is perpetual or periodical, FIFO will give what? The same answer.
No, sir.
There is no difference. Go to question number 64. Inventory purchased for 25 has been incorrectly written down at the end of the year at replacement cost of 17. Currently it is selling for 15. That is a normal selling price. This happened in the last year, not current year. This happened in the last year. We have taken at 17. Instead of 25, we have taken at 17 in the last year. That is like opening stock. Okay, this is currently selling at 50. This is currently selling at 50. Simple. The income of this year will be overstated. Why? instead of 25, we have taken at 17. We can sell them for 15 means 50 means it will be like 50 minus 17. 33 will be your profit. If you would have taken at historical cost, 25 would have been your profit. So the profit is what? Overstated. The profit is overstated. Last year the company determined carrying amount of 5 lakhs. Okay. 5 lakh was impaired. 5 lakh was impaired because of the demand in the product collapsed. Okay. As a result, company wrote down the inventory to zero. Wrote down the inventory to zero. This year, however, the government authorities unexpected announced the competitor with product will be defective. The product was removed from the market. Because of that, okay, again, that goes up to, realizable value. That goes up to realizable value at the end of the current year. How should the company record under the new development for the current year? Simple. IFRS recommends fair value accounting. IFRS recommends what? Fair value accounting. So it should be carried out whatever is the value. Like how much you have written off from the last year? How much you have written off from the last year from the inventory value? 5 lakh. Just add it up. Just add it up. When you follow US GAAP, whatever is written off in the last year is written off in the last year. We sell that only when the realized profit is realized, we can record it. So as per US GAAP, nothing will be written up. Nothing will be written up. So why to write up 5 lakhs? Simple. Last year, how much you have written off from inventory value? 5 lakhs. This year, the market conditions have improved. You can sell them at normal price. Okay. Do not consider NRV. Do not consider NRV. This 5 lakhs was written off. 5 lakhs was written off. Whatever was written off will be added back. That is write up the inventory. Under US GAAP, simple. Whatever is written down or zero is zero. That's it. So that is what. Question number 66. Okay, year one end, 40,000 inventory was counted twice. More inventory. In the second year, the inventory error was rectified. As a result of that, year one error was that. Simple, 40,000 we have eliminated twice. Otherwise, 40,000 was included in inventory twice, which means cost of goods sold of the last year would have been low. Cost of goods sold of the last year would have been low. And second year earnings would have been correct. Second year return earnings would have been correct because we rectified the error. Answer is D. All sales purchased in the year are credit transaction. Okay. We are using perpetual inventory system and shipped goods that were correctly excluded from ending inventory. In error, the sale was not recorded. In error, the sale was not recorded given. When you don't record the sales, book entry gets affected. Book entry gets affected. The journal entry is like accounts receivable, account data to sales. You have not recorded. Because of that, accounts receivable would have been understated. Income would have been understated. Which one is the correct option? See, point number A, inventory will not be overstated. Why? Because once the inventory moves out, they would have accounted it. They would have recorded it. Inventory is not overstated. No. So B cannot be an option. B cannot be an option because accounts receivable was not affected. No. See, accounts receivable was understated, correct. Inventory was not affected, correct. Sales was understated, correct. Cost of goods sold was understated. No. Accounts receivable was understated. Inventory was not affected. Sales was understated. And sales were understated. Cost of goods sold will not get affected. This is the option. So it will affect, if you don't pass a journal entry, it will affect only accounts receivable and which one? Sales. It will affect only accounts receivable and which one? Sales. Inventory would have moved out to the customer, that is not affected. Cost of goods sold is also not affected. Because inventory has moved out, cost of goods sold would have been properly recorded. Question number 68. We shipped to Gibson company, we are selling. The terms of sales is net 30. They have to pay net 30. FOB shipping point means once we ship the goods, our responsibility is over. Okay. So on 31st January itself, we should record the sales. FOB shipping point, my revenue can be recognized on 31st December. They took the delivery on January 5, year 2, because of the confusion about shipping terms. The sales was not recorded until January of the year 2. Markup of 25% on cost is given. This was included in the inventory is given. Actually, we should have recorded as sales and eliminated from inventory. On 31st itself, we have just loaded the goods in the ship. So sales is complete. Sales is complete. Actually, the sales should have been completed. Income before income tax for the first year would have been, markup is 25% on cost. What do you mean by 25% on cost? If profit will be 25, if cost is 100, then what would have been the selling price? What selling price would have been 125. This 125 is like 75,000. 125 is like 75,000. Then what would have been the profit? What would have been
15,000.
15,000. 75,000 into 25 by 125. How much you get? 15,000. So profit would have been understated by 15,000. Profit last year it was not recognized. So profit would have been understated by 15,000. Should have recorded sales but not recorded it. So the profit would have been understated by 15,000. Inventory overstated for 31st December of this year. Inventory overstated, which means it will increase the income of the current year. It will increase the income of the current year. More inventory is recorded, it will result in lesser cost of goods sold. More inventory is recorded, it will result in what? Lesser cost of goods sold. Current year income will get overstated. Next year income will get understated. Next year income will get understated. This is correct. The following inventory valuation errors are being discovered in NOC Corporation. At the year 1, inventory was overstated. Second year, first year inventory is overstated. So when you rectify the error, it should be $1,38,000 minus 15,000 minus 23,000 minus 23,000. Because if inventory is overstated, that year profit is overstated. So what will be the answer? 1,38,000 minus 23.
1,15,000.
Second year, 2,54,000. The closing inventory of the last year becomes beginning inventory of the current year. So the income would have been understated, add 23,000. And of course, closing inventory is understated, means the profit would have decreased, add 61,000. Add 61,000. Last year ending inventory becomes beginning inventory of this year. Last year income is understated. This year income would have been, so last year income is, overstated, so we eliminated. This year income would have been understated, we add back. Closing inventory was understated. Because of that also income would have been understated. What is the answer?
3,38,000.
Then next year, yes, I hope understated. So it would be 1,68,000 minus 61,000 plus 17,000. What is the correct answer? One lakh 68 minus 61 plus 17.
1,24,000.
So 1,15,000. This is 3,38,000. The other one is like 1,24,000. Which option is correct? This option is correct. Yes. Go to question number 71. $25 has been incorrectly written down to net traceability of 17.5. This is currently selling at 15. It is normal selling price. Which of the statement is correct? Yeah, income and secondary will be overstated because we have taken at 17.5, which we can sell it for 50. Okay, it would have been 37.5 instead of 25. If you would have recorded at cost, it would have been 25, but we have taken at what? 17.5. So profit of the secondary will be overstated.
Is it 90,000, sir?
Okay. What is the weighted average cost?
Cost of the product.
90,000. And what is the net realizable value?
1 lakh.
1 lakh. And they have given lower of cost or net realizable value. Lower of cost or net realizable value. So cost or NRV. So whichever is less should be taken. So which one should be taken?
90,000.
90,000 is the correct answer. Read 73.
Option C.
Lower of cost or which one? Net realizable value. Lower of cost or net realizable value. The information contains about Wilson's industry. They are following which one? LIFO cost flow assumption determines the cost of goods sold. The limit is designated market value, ceiling and the floor respectively. That lower of cost or market value comparisons of cameras. They ask you to work out the value of which one? Cameras only. They ask you to find out ceiling and floor. What is ceiling? Can you tell me what is ceiling? Now tell me what is ceiling in this NRV?
$198.
217 minus 19. How much?
198.
198. They asked mid value NRV minus normal profit. NRV minus normal profit. 198 minus what is normal profit?
32.
Then replacement cost. Replacement cost. Cost to replace. 203. No. Mid value is replacement cost.
NRV minus normal profit of flow. Correct.
What is the replacement cost? 203.
203.
So they ask you the question, lower of cost or which one? Market value comparison. They ask you to find out ceiling and floor Keterka. Ceiling and floor is 198 and what? 166. 198 and 166.
Mid value is the designated market. Lower of cost or market.
Okay.
But the question is this which midpoint is called as designated point.
Okay.
So in the question they ask you ceiling and floor. Ceiling and floor. Ceiling and floor is what? 166. Of course, floor 198. Look at the next one. Same data. They ask you to find out the value which one? Triparts. For the triparts, what is NRV? Selling price minus cost to sell. 73.75 minus 2.5. How much you get? $73.75 minus 2.5. 71.25. What is replacement cost? What is replacement cost? It is 51. Floor. NRV minus normal profit. NRV minus normal profit is nothing but 71.25 minus normal profit 21.25. How much it will be? 50. So applying this, what will be the designated market?
51.
It is the midpoint.
$51.
51. Compare this with cost. Compare this with cost. What is the cost? 53. So take whichever is less. They ask you to find out the value of the product, value of the cost of goods sold. Determine the value of inventory for cost of goods sold they ask for. So designated market or cost, whichever is less. Designated market or cost, whichever is less, should be 51. The designated market is the midpoint. Of course, cost is 53, so whichever is less, 53. According to Federal Accounting Standard Board, which of the following attributes would not be used to measure the inventory?
Historical cost.
Which will not be used to measure inventory. We don't use any concept called as present value of future cash flows. We use historical cost, NRV, replacement cost, but not which one, present value of future cash flows. Which of the following errors will result in overstatement of net income? Overstatement of ending inventory. When closing stock is more, cost of goods sold will be low. Cost of goods sold will be low. It will result in overstatement of net income. 78. We are reclassifying the investment from debt security to what? Available for sale security. Okay. Available for sale to held to maturity. Okay. We are. Okay. So they are classifying from available for sale to held to maturity. See, available for sale securities will be recorded at fair value, fair market value. For example, I'm having a plant, property, equipment or investment. When I hold it for sale, I'll record it fair value. I'll record it what? Fair value. If I classify it into held for maturity, means it's a long-term investment. Long-term investments are generally shown at cost price. Generally shown at what? Cost price. So net income will not be affected. Only when that, for example, you are holding a long-term investment for 1 million, that will appear at 1 million. Unrealized loss and gains will not affect your net income. Not affect your net income. What is the impact of the fair value change? Fair value change in OCI. OCI for year 12 and year 13. They ask impact of this and this. See, trading securities will be valued at cost or market value, whichever is less. Cost or market value, whichever is less. So market value is 2,45,000, 2,49,000. So we will not consider these values. Trading securities, cost or market price, whichever is less. So we will continue to hold it at or show it at 2,25,000. Held to maturity securities will continue to appear at what price? Cost price. It will continue to appear at cost price. All the other values are irrelevant. We will not check. Long-term investments will appear at what price? It will not check. Available for sale securities will be shown at fair value. Available for sale securities will be shown at what? Fair value. It was 3,35,000. Now it is 3,50,000. Last year it was 3,35,000. Current year it is 3,50,000. Means there is a change by 15,000. There is a change by what? 15,000. From 3,50,000 it becomes what? 3,56,000. We know unrealized gains are recorded in OCI. Unrealized gains are recorded in which one? OCI. So this 15,000 increase will be in OCI. Second year 6,000 increase in OCI will happen. Answer is C. The question is, what will be the change in other comprehensive income? What will be the change in other comprehensive income? Any doubt in it? Trading security, cost or market value, whichever is less. The impact will be in income statement. Held to maturity, it will continue to appear at cost. Available for sale only. Change in the fair market value will be recorded in which one? OCI. So there is an increase by 15,000, another by 16,000, 6,000. So in both the cases it increases. Okay, year 1 to year 2, 15,000 increase. Year 2 to year 3, 6,000 increase. Read question number 18. a decline in fair value below the amortized cost of available for sale of investment in a debt security should
Impairment.
Should be tested or evaluated for which one? Impairment, to determine how much of credit loss which should be recognized in which one? Net income. Okay, so that we have to check. Okay, if the fair value okay is below the amortized cost, you check for impairment loss and recognize it. An investment in available for sale debt securities is valued in the statement at
Fair value.
fair value. Always available for sale. Let it be investment or properties, anything, it will be recorded at what? Fair value. If there is a fair value change, we will recognize in OCA. We will recognize in which one? OCA. Which one should be classified as available for securities? The question is, they have given you 3 securities. Which one should be classified as available for sale securities? So we are going to hold it till they mature. Until they mature, it is not available for sale security. And shares of PF company is very profitable. We are going to increase our ownership and we are not going to sell it. We are not going to sell it. So it matures in 3 years, but these bonds will be sold when it is needed. When it is needed means it is available for sale. It is available for sale. Only the third will be taken as what? Available for sale securities.
So, இங்க power cuts, laptop power ஓடிட்டு.
Okay. An investment in trading securities is valued in statement of financial position at their fair value. Their fair value. While using the fair value accounting, it would be the firm's benefit to report the liability at the fair value when it has report the liability at fair value.
No idea.
Compare these two. Compare these two where the value is high. Compare 28 and 98. What is the difference? $80, right? 70, okay. 101 and 32.
69.
69. So it will be beneficial to record the liability at fair value. At fair value when 28 million is outstanding bonds trading at what? 98. Read 85. Several marketable debt securities is given. The following are the details are given. Comprehensive income change they ask for. Comprehensive income change they ask for. Comprehensive income change will happen. Held to maturity securities will be recorded at cost. It will not affect your comprehensive income. It will be recorded at what price? Cost price. Available for sale security, the fair value change will be reported in what? OCI. It will be reported in OCI. Only trading securities, okay, the thing will come in what? The common income. That is your income statement. That is your income statement. From 2,38,000 to 2,45,000, there is an increase by what? 7,000 and
4,000.
Wait. Check the question. Is it net income or comprehensive income?
Comprehensive.
Comprehensive income includes both net income as well as what? OCI.
Available for sale.
So in the net income, what will happen is the trading securities value will be adjusted. Trading securities value from 2,38,000 to 2,45,000. 2,38,000 to 2,45,000, how much? 7,000. And OCI will be adjusted for available for sale securities. From 3,35,000 to 3,50,000. 15,000 will be adjusted. So total of 22,000. Then that is for the first year. Second year, net income trading securities 2,45,000 to 2,49,000. How much? 4,000 plus OCI 3,50,000 to 3,56,000. 6,000. Totally how much? 10,000. Please remember the question is about comprehensive income. Comprehensive income includes both what? Net income as well as OCI. Trading securities, the change in fair value will be adjusted in net income. Available for sale securities, the fair value change is recorded in which one? OCI. So total comprehensive income change will be 22,000 and what? 10,000. Held to maturity securities, they are recorded at what? Cost. They are recorded at cost. It will not affect. It will not affect. What is the correct answer? D. Wrongly rated as net income. Net income, the answer would have been C. We are holding 30%. We paid 7 lakhs for 1 lakh shares. 7 lakhs we paid. 30% of net assets are 5 lakhs. Excess amount paid is called as what? 2 lakhs. Excess amount paid is called as 2 lakhs. That is like goodwill. Then excess of cost over fair value was attributable towards goodwill. This is what they've given. This 2 lakhs is attributable towards goodwill. Current year they reported a net income of 3 lakh and they paid a cash dividend of 1 lakh. So what is the change? 3 lakh, dividend paid is 1 lakh. So we're able to have a significant influence கேட்டிருக்காங்க. We follow equity method of accounting. Very simple question. What is the net income earned by the company? 3 lakhs. Net income earned by the company is 3 lakhs. In that 3 lakhs, how much belongs to us? 30% belongs to us. 3 lakh into 30% belongs to us. 90,000 will be our share of income. The question is about share of income. 3 lakh into 30% will be how much? Share of income is 90,000. Yes, 90,000. We are holding like 30% of investment in the other company. So 30% of net income belongs to us, 90,000. Here, we are not having significant influence over the other company. They recorded as long-term investment. They are recorded as which one? Long-term investment. They have recorded as which one? Long-term investments under fair value method. The question is about the amount of net investment revenue. Simple. When you hold long-term investments, what is your revenue? What is your revenue? Dividend received from the company. Dividend received from the company. What is the dividend received? Total dividend declared is 1 lakh. In that, we would have got 30% dividend. So, how much is the net income for us? Otherwise, when you hold long-term investments, the dividend distributed becomes their payment, and whatever we collect becomes income. 1 lakh into 30%, how much? 30,000. That is our income. That is our income. Read further. A company applies equity method of accounting when you are having 20% or more ownership. We call it a substantial interest. Substantial interest holder will apply what? See, less than 20% investment. 20 to 50% it is called as equity method of accounting. 51% or more it is called as holding and subsidiary company. It is called as holding and subsidiary company. We are holding 40% of company at 3 lakhs. They reported earnings for how much? 10,000. They reported earnings of how much? 10,000. We received 15,000% dividend கொடுத்திருக்காங்க. Based on the information presented, the proper percentage of the investment result in see, they earned a net income of 10,000. They earned a net income of 10,000 and they distributed a dividend of 15,000. What would have happened to the net worth of the other company? Earnings are, they earned 10,000 and distributed what? 15,000 dividend. So their net worth would have been dropped by what? Reduced by 5,000, right? You paid more than what you earned. You paid more than what you earned. So net worth drops by 5,000. So when you apply the equity method of accounting, simple, net worth of the other company drops by 5,000. So investment value also will drop by 5,000. So it will result in decrease in the book value of the investment. Okay, maybe. What is equity method of accounting? Cost of investment we will take, okay, add share of net income. Why? Because it increases our net worth. It increases our net. Lakshmi, shall we proceed? 105 Paran. We purchased a piece of equipment for 1 lakh. In addition to the purchase price, we incurred 5,000 for freight, 3,000 for installation, 2,000 for testing and 1,000 for modifying existing structure to accommodate the equipment. How much should be recorded as cost? How much should be recorded as cost? See, what is cost of fixed asset? Anything that is spent to bring the asset into current location and condition. So all the cost is bring the asset to current location and condition only. So all can be included in the cost of the asset. 1 lakh plus 5,000 plus 3,000 plus 2,000 plus 1,000. What is the cost of the asset? 1 lakh 11,000. What is the cost of the asset? 1 lakh 11,000. Any amount spent to bring the asset to current location and condition can be included. So 1 lakh 11,000.
Interest on notes payable.
1 lakh is interest bearing notes payable. cost in addition to that 1,50,000. We should include all the following except Ketrika. Interest cannot be included. Interest can be included only when it is paid during the construction period. Okay. So if it is not, there is no construction, that cannot be included. Here we are purchasing, we are not constructing. So interest cannot be included in the cost. That is not part of your acquisition cost or development cost or whatever. Read the next one. Cost of the machine is 63,000. 20,000 was given as down payment, remaining 12% annual interest. And that additional cost included how much? 2,500 for shipping, 4,000 for installation, 3,000 for testing, 1,290 on which one? Interest on borrowed funds. So what is the cost of the asset?
22,500.
This 63,000 can be included. This 2,500 can be included. 4,000 can be included. 3,000 can be included. 1,290 cannot be included because it is not paid during any construction period. Answer is what? 72,500. We purchased for 1,50,000, 7,000, 5,000, installation 3,000, 4,000 for modifying floor, 2,000 is for staff training. 2,000 for staff training. That cannot be included. Staff training 50 plus. $2,000 has been spent for how to perform in maintenance. Okay, it is not maintenance staff. How to perform maintenance equipment. The company also received a discount. Discount will be eliminated. Discount will be eliminated. So what is the cost of the asset?
So will we include this 2,000?
Yes, because it is not maintenance. It is training the staff how to perform maintenance. Training the staff on how to perform. It's not like maintenance staff salary. We train the staff as to how to perform. It is also part of what? Bringing the asset into current location and condition. So what is the answer? 150 plus 7 plus 5 plus 3 plus 2 minus 2,500. This is minus 2,500. How much you get?
1 second.
157, 162, 165, 160. Even this 4,000 can be included. Wait. This is for staff training on how to perform maintenance. No, this is not part of your cost of the asset, right? Yes, this 2,000 is not part of cost of the asset. That is spent after the asset is, brought into usable condition. So work out 150 plus 7 plus 5 plus 3 plus 4 minus 2,500.
1,66,500.
So this 2,000 cannot be included. So I read it wrongly. That is not installation cost, correct. Plant property equipment should be recorded at what? Cost minus accumulated depreciation. Cost minus accumulated depreciation. $2 lakh cost 2,000, shipped 4,500 to construct and prepare the site, 3,500 for installation is given. Estimated useful life of the asset will be 5 years. Salvage value will be what? 15,000. Now tell me what is the cost of the asset?
2,10,000.
2,10,000. So while putting depreciation, 2,10,000 minus scrap value how much? 15,000. This divided by how many years? 5 years. What is the answer? The following information is available to plant, property and equipment is given to us. They are using SLM. They are using which one? SLM. Building was depreciated based on 20 years life. Based on 20 years life. Estimated salvage value 6,000. What would have been the depreciation? 36,000 minus 6,000 divided by 20 years. What would have been the depreciation? 36,000 minus 6,000 divided by 20 years. 30 years. 30,000 divided by 20 years.
15,500.
1,500. So depreciation charge is 13,500. Depreciation charge is 13,500. Annual depreciation if it is 1,500. How many years gone? Annual depreciation if it is 1,500. How many years gone?
9 years.
9 years over. 9 years over out of 20 years. So 20 years in that 9 years over. Now balance, what is the life? Oh, okay. They ask you not balance life. They ask you how many years the asset has been depreciated. How many years the asset has been depreciated? How many years? 9 years. Annual depreciation 1,500. So 13,500 means the asset has been depreciated for 9 years. The asset has been depreciated for 9 years time. The company acquired a delivery truck at a cost of 20,000. The truck has a useful life of how much? 2,000 salvage value. Acquired car for deliveries, estimated life is 3 years and 6,000 salvage value. They ask you to find out for year 2 using double declining method for delivery truck. So what is the depreciation normally? 20,000 by 5 years.
4,000.
So rate of depreciation would have been 4,000 divided by 20,000 into 100. The rate of depreciation would have been 20%. So double declaring method will apply what? 40%. They ask you to work out depreciation for the second year. So what is the cost of the asset? 20,000 minus 40%. It would have been 8,000. Balance would have been how much? 12,000. On that 40% you apply
7,200.
second year depreciation is 7,200. So 20,000 by 5 is it 7,200? Check. 12,000 into 40%, please check. You put 4,800.
Makes sense.
Answer is D. Under double declining method, we work out depreciation normally like SLM, ignoring the salvage value. So 4,000 divided by 20,000 into 100, we get what? 20%. Double declining method, 40% we apply like WDV. 20,000 minus 40%, then 12,000 into 40%. Second day depreciation for the delivery truck. delivery car using sum of the years digits method. What is the life of the asset? 3 years. For year 3 கேட்டிருக்காங்க. For year 3 கேட்டிருக்காங்க. So after sum of the digits will be like 1 plus 2 plus 3. It will be how much? 6. So for third year it will be like one more year life. 1 by 6 into 4,800 minus 600. How much you get? Sum of digits are 6. 1 plus 2 plus 3, 6. For the third year, it will be like only 1 year left. So 1 by 6 into cost minus salvage value.
700.
700. Correct. But option in line path. 700 is the correct answer. You understand? Cost minus scrap value into the remaining life. Third year, one more life is there divided by sum of digits. $40 given. For 15 years it is given. Average life is 40 years, but the rate will be popular. Estimated useful life is 15 years. Estimated useful life is what? 15 years. And that will be dissembled based on the local economy, which is difficult to predict, which means we are not clear whether, there will be ups and downs, etc. and all. Okay. So, we can straight off over 15 years using which method? Straight line method. See, depreciation is always based on estimated useful life. Depreciation is always based on which one? Estimated useful life. Most plants have limited useful life. All of the following factors limit the useful life except deterioration, wear and tear. Tax regulation will not determine your estimated useful life. It will only tell you how much depreciation on the market. First January of the current year is 1,08,000. 4 years life, residual salvage value 1 lakh. Double declaring method they asked for. For the current year they asked for.
Option C.
Your 4 years life means 25%. 25% into 50% into 1,08,000. Correct. If it is 5 years life, 20%. 4 years life, not 25%. So double declaring method, 25% into 2, 50% of 1,08,000. That is the answer. C, correct.
Option C.
Which of the following method will result in greatest amount of depreciation? 5 years now, 40% or 20% into 2. 40% will come under which one? Double declaring method. SLM equals spread. WDV also, not that thing. So double declaring method will give the highest thing. The factors primarily relied upon determining economic life of the assets are
Option B.
yes, time, asset usage, and which one? Obsolescence. When a fixed plant has 5 years estimated useful life is sold during the second year, accelerated depreciation method, the straight line method affect the gains and losses of fixed plant கொடுத்திருக்காங்க. 5 years sold during the second year. Sold during the second year. Accelerated method of depreciation instead of straight line method of depreciation. Accelerated method like half, then like that it goes. 4 years convention it goes. We are selling the asset during the second year. We are selling the asset during the second year. instead of SLM. Where depreciation will be more? Under which method depreciation will be more? Accelerated depreciation method, depreciation will be more. When you charge more depreciation, the asset value will be less. Asset value will be less. So book value is less. When you sell it, okay, either the gain will increase or loss will decrease. Either the gain will increase or what? Loss will decrease. When the accelerated depreciation method, we charge more depreciation. So the book value of the asset will be less. So when you sell it, either the gain will increase or the loss will decrease. Okay. Installation charges 300, delivery charges 200 also were incurred. Machine is expected to have a useful life of, salary is value 1500 is given, 9000 is given. So they ask you to find out cost of the machine. So 9000 is the original cost plus 300 plus took the delivery at 200. Salvage value doesn't matter. 9000 plus 300 plus 200. The cost of the asset is what? We are not bothered about number of units produced. Cost of the asset is 9500. Cost of the asset is how much? 9500. Depreciation is nothing but allocating the cost of the asset based on the estimated life. Okay, based on the period of use. SLM for first year and second year would be SLM they asked for. What is the SLM depreciation? 43,200 minus 3,600 divided by how many years? 8 years. How much you get?
4950.
4950. 4950. One half of the depreciation on all assets purchased and sold during the current year. One half of the depreciation is given. How much you get? How much you got?
4950.
One half of the depreciation will be 2475. Read the next one. Sum of the year's depreciation they asked for. What is sum of digits? 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8. What is sum of digits?
36.
For year 2, the balance life will be 7 years. 1 year is gone. From year 2 to year 8, 7 years life. Into, what is the cost? 43,200 minus scrap value 3,600. How 7? From second year to 8th year. Second year to 8th year, it is not 6 years life, total 7 years life. So 7 by 36 into 43,200 minus 3,600. What is the answer?
$7,700.
Check. Be careful about the question. June 1, year 1. 31st May year 2. Oh, I made an overreading. Okay. June 1 year 1. The accounting year, for example, this year June we purchased. The accounting year will end on what? 31st May of the second year. My God. Okay, it is not year 2. Okay, we purchased on 1st June. Our accounting year ends on what? 31st May of the second year. So it will be like 8 by 36. The question is they ask you depreciation for the first year. Depreciation for the first year.
8,800.
Correct. 8,800. Even the last question was like that. Even the previous question was like that. Okay, June 1 to 31st May of year 2 means for first year only half the depreciation 2475. Double declining method. Double declining method for which means second year they ask for. Second year they are asking for. So if it is 8 years, 1 by 8. 1 by 8 will be 0.125, nothing but 12.5%. So under double declaring method, we'll use 25%. So what is the cost of the asset? What is the cost of the asset? 43,200. Depreciation for the first year. Depreciation for the first year will be 25%. How much it will be? 25% of 43,200. Otherwise, you can work out normal depreciation also. 43,200 divided by 8 put. Then you can work out rate of depreciation. Otherwise, simply 1 by 8. So, first year depreciation 43,200 into 25%. What is the answer?
10,800.
Then balance will be on the 32,400. On the 32,400, 25%. Year 1 to year 2, year 2 to year 3. So 25% will be how much? 25% of 32,400.
8,100.
8,100. That is the answer. Nila Corporation computes depreciation nearest whole month. A new piece of equipment was purchased expected to produce 4 lakhs units in the estimated useful life of 8 years. The total cost was 3 lakhs. Salvage value is 30,000. Nila implies calendar year. Annual production for the first year is how much? 34,000 for the car. Using the units of production method, 34,000 divided by 4 lakhs. Divided by 4 lakhs. Into cost minus scrap value. 3 lakhs minus 3 lakhs minus 30,000. 3 lakhs minus 30,000. What is the answer? 34,000 by 4 lakhs into 3 lakhs minus 30,000. What is the answer we get? 34,000 divided by 4 lakhs into 3 lakh minus 30,000. What is the answer? 22,950. 22,950. Amount of depreciation in 2013 they asked for. Try பண்ணு. See, we put into use the asset on was only 2001. So for 2001, it is used 0.5 years. 2002 it is used for 1 year. 2003 okay, 1.5 year already used. 1.5 year already used. So what is the balance life? What is the balance life? 6.5. 6.5 balance life. Sum of digits are 36 into cost minus scrap value portable.
Why 36, sir?
Sum of digits
Yours, okay, yes.
8 years old 36. And we see in 2001 we didn't use for the whole year, 6 months da. So 6 months, 1 year is over in 2002. 2003 calendar year 1 year, which means balance life is 6.5 or 36 into 3 lakhs, salvage value is 30,000. Work out this.
0.5 divided by 5.
48,000 sound. So first year we didn't use for the whole year. So only 0.5 years, 6 months. Second year is 1 year. So 1.5 years over. Remaining life will be 6.5 years out of sum of digits 36 into 3 lakh minus 30,000. So be careful about the question. This is 5 years life. This is in year 1. This is in year 2. That is also 5 years life. Okay. This is they ask you to work out for year 4. Work out part. It's a little lengthy question. Try to work out. This happened in year 1, this happened in year 2, this happened in year 4. We are in year 4. For the first asset, 1 lakh minus 20,000 into 5 years sum of digits will be 15. 5 plus 4 plus 3 plus 2 plus 1, 15. We are in 4th year. So 2 more years of life. Oh, installation cost 20,000. Installation cost 20,000 minus scrap value. How much minus scrap value? 10,000 into 4th year and 5th year life only. 2 by 15. What is the answer you're getting for this?
14,666.66.
14,667. Second asset we purchased 45,000 in year 2. So 45,000 in year 2. It is having a life of how many years? 5 years life. So 5 years life. We are in year 4. So how many years over? Year 2, year 3 over. 3 more years life is there. 3 more years life is there. This into 3 by 15. How 3 by 15? Already how many years life over? Already how many years life over? 2 years life over. Year 2, year 3 over. We are in year 4. So 3 more years life. How much it is?
9,000.
And the third machine, which was purchased now only, 60,000 minus 7,000 into we purchased now It will be 5 by 15. 5 by 15. What is the answer? $16 minus 7. This year only it is purchased into 5 by 15. How much you get?
17,667.
17,667. Add up all the things.
20, sorry,
34. 34 should be correct.
1,300.
40,334. 40,334. Go to 131. A Ford purchased on 1st January, year 1, 1 lakh. Installation cost were 20,000. The Ford has an estimated salvage value of. Same question, Dani.
Same data, sir. Double declining balance.
Double declining balance. Double declining balance method. So we have to work out each asset separately. 5 years life means 20%. 5 years life means it will be what? 20%. So we have to apply double declining method. 1,20,000. This is 45,000. This is
60,000.
the 60,000 is purchased only now. Double declining method, 20% normal depreciation, it will be 40%. This was purchased in year 1. It was purchased in year 1, we are in year 4. So let us work out 4-year depreciation. This into 0.4. First year, second year, third year, and of course, fourth year. This was just purchased last year. This was purchased in which one? Year 2. And this was purchased only in the current year. What is the mistake I've done? So for the first asset, first year, second year, third year, fourth year depreciation. Second asset was purchased in second year. So second year, third year, current year depreciation. This was purchased in the current year depreciation. So 40,848 is the answer. 40,848 is the answer. Any doubt in it? 5 years life now it will be 20% depreciation. 1 by 5. 1 by 5 means 0.2, 20%. So double declining method 40%. First asset we provide for 4 years. Second asset we provide for 3 years. And the current asset we provide only for what? 1 year. SLM. SLM. Okay, simple. We can work out simply. This is 1,10,000 divided by 5 years. First asset, cost minus scrap value, 1,10,000 divided by 5 years. How much it will be? SLM depreciation will be uniform. How much? 22,000. Second asset, 45,000 minus 5,000 divided by 5 years. How much?
8,000.
40,000 divided by 5 years. It will be uniform. 8,000. Third asset. Third asset. Third asset. 60,000 divided by, what is the salvage value given? 7,000. So it will be 53,000 divided by 5 years.
10,600.
Add up all the thing.
40,600.
40,600. 40,600. There is a component that will have a life of only how much? 5 years. 2,20,000, 5 years with a residual value of 10,000 is given. The cost allocated to the main part of the machine was 6,80,000 with a useful residual life of how much? 20,000 கொடுத்திருக்கான். So out of 9 lakh, 2,20,000 balance 6,80,000. Residual life is 20,000. Or depreciate using SLM. At the end of 5 years, we replaced with another cost, what, 3,50,000. No residual values assigned for the replacement of laser is given. Original cost was sold for, laser was sold for 2,000 கொடுத்திருக்காங்க. What is the carrying amount of which machine? Lab machine, including the laser, just before what? The replacement of laser. Think on that and work out. Try பண்ணுங்க. The total is 9 lakhs. See, laser component of the equipment, this life is what? 5 years. So the laser value would have become 0. Would have been depreciated. Fully, because 5 years lifetime. The part would have been depreciated fully. Only residual value will be there. So only the 10,000 will remain. Only the 10,000 will remain. The other machine, equipment, cost is how much? 6,80,000. For this, depreciation charge would have been 6,80,000 minus, what is the residual value? 20,000 divided by 10 into 5. See, 5 years life, laser would have been fully depreciated. The component would have been fully depreciated. So only the salvage value will remain. The other asset, 6,80,000 minus 20 divided by 10 years. In that 5 years life is over. Now how much it will be?
We like 20,000.
So what would have been the carrying amount? 6,80,000 minus 3,30,000, how much? 3,50,000. So what would have been the total value? 10,000 plus 10,000 plus only salvage value will remain, the other asset value will remain. So 10,000 plus 3 lakh, it would have been how much? 3,60,000. See, the component would have been fully depreciated. Only the salvage value will remain. And the remaining equipment, 6 lakhs 80 lakh minus 3 lakh 35 years depreciated. So 3 lakh 50 will come. So 10,000 will come. Same question. What will be the revised carrying amount? What is the revised carrying amount they ask you? So we already worked out 3 lakh 60. 3 lakh 60. We spent 2 lakh 50. 3 lakh 60 plus we spent how much? 2 lakh 50. This is removed. This is removed. This is removed. Old component has been replaced. Okay. Equipment will continue. Equipment will continue. Plus we are adding the new component 2 lakh 50. Simple value will be, we worked out value of equipment. Value of equipment after 5 years. Already we worked out how much? 3 lakh 50. That old component is replaced with a new one. Add new component value. New component value will be 2,50,000. 3,50,000 plus 2,50,000. What is the answer? 6 lakhs is the carrying amount of the machine after the replacement. They ask you what is the depreciation after the replacement of laser. Depreciation after the replacement of laser will be, for the equipment we will continue to provide the same depreciation. For the equipment we will continue to provide what? The same depreciation. Okay. Depreciation on equipment. How much? 6 lakhs 80 minus 20,000 divided by 10. 6 lakhs 80 minus 20,000 divided by 10. What is the depreciation?
66,000.
66,000. For the new component, what is the new component? 2 lakh 50,000 divided by 5. 2 lakh 50,000 divided by 5. There is no scrap value for the new component given. New component replaced, but there is no new value given for this. The replacement value, residual value given for this. How much it will be? 50,000. What is the total? 1,16,000. 1,16,000. Answer is C. Done. This is for 135.